Hey everyone, welcome back to Corporate Decoder. Today we're diving into General Mills' latest financial report, which pretty much reads like a company trying to put a brave face on some tough quarter, and spoiler alert, there is a big sale happening that changes the game. This is General Mills' latest quarterly report, and it tells us what happened in the 3 months leading up to November 2025. Now, you might think a food giant like General Mills is just churning out Cheerios and gold medal flour, but they've got a lot more going on, including a significant divestiture that is making their numbers look a bit complicated. Let's start with the top line. Net sales for the quarter were around $4.8 billion, and for the 6-month period ending November 2025, that number jumped to over $9.3 billion. This is a decrease from the previous year, and the report attributes this to lower sales volume. Think of it this way. Fewer boxes of cereal or bags of flour are being sold. Now, operating profit, which is basically how much money they made from their core business operations before interest and taxes, took a big hit. In the second quarter of fiscal 2026, it dropped 32% to just under $728 million. The report points to a big reason for this: restructuring, transformation, impairment, and other exit costs. What does that mean in plain English? Well, it means they incurred a lot of expenses related to closing down parts of their business, writing off assets, and generally cleaning house. This is where things get really interesting. The report details nearly $122 million in these types of costs for the quarter. A big chunk of that, over $52 million, is a non-cash impairment charge for their Uncle Toby's brand. Impairment means the brand is not worth as much as they thought. They also approved a multi-year initiative to improve their supply chain, which added another $47 million in charges. On top of that, there were $22 million in charges for previously announced restructuring actions. This is the cost of making big changes, and it's hitting their profits hard right now. But then we see this line item: divestitures gained for over $1 billion in the 6-month period. This is the money they made from selling off parts of their business. Specifically, they sold their United States yogurt business. This sale is a massive factor in understanding their financial results. It's like selling a whole factory. You get a big chunk of cash, but it also means you don't have that business generating sales or profit going forward. This is a classic example of how big strategic moves can make financial reports look a bit dizzying. Let's talk about goodwill. This is an accounting term that represents the extra money a company paid for an acquired business above its identifiable net assets. General Mills has over $15 billion of goodwill on its balance sheet. In the 6-month period, they had a pretty significant adjustment of over $32 million related to this goodwill, partly due to purchase accounting adjustments from acquisitions. This shows how complex acquisitions can be, and the accounting for them can continue to impact financial statements long after the deal is done. While the big corporate numbers can be confusing, let's look at how their individual businesses are doing. The North America pet segment is showing growth. Net sales increased 11% in the second quarter. This is primarily due to a combination of higher prices and better product mix overall. They bought Whitebridge pet brands in the previous year, and it seems to be contributing quite well to this segment's growth. The international segment also saw an increase in net sales, up 6% for the quarter. This growth was driven by more volume sold and favorable foreign currency exchange rates, meaning their foreign earnings were worth more when converted back to US dollars. However, the North America retail segment, which is the biggest part of their business, saw a significant 13% drop in net sales. This is largely due to the divestiture of their US yogurt business. Even when you look at organic sales growth, which tries to strip out impacts like divestitures, the numbers here are still down, showing weakness in their core retail operations, particularly in their Big G cereal and Canada unit. When we look at adjusted operating profit, which tries to smooth out some of these one-time or unusual items like divestitures and restructuring costs, the picture is still one of decline. For the quarter, adjusted operating profit was down 20%. For the 6-month period, it was down 19%. This suggests that even after accounting for these big events, the underlying profitability of their ongoing businesses is under pressure. They are facing higher input costs, meaning it costs more to make their products, and while they've managed to pass some of that along through price increases, it is not enough to offset the overall challenges. This pressure on profit is also reflected in adjusted diluted earnings per S-share, which dropped 21% for the quarter. This is the measure most directly impacting shareholders' pockets, and a significant drop here means less profit per S-share for investors. Looking at their debt, General Mills has a substantial amount of long-term debt, over $12 billion. While they appear to be in compliance with their debt covenants, managing this level of debt, especially with rising interest rates, always carries a risk. They've been actively managing their debt, repaying some and issuing new notes, but it is a significant financial obligation. Finally, a quick look at shareholder equity. The company has over 533 million shares outstanding, but they also hold a significant number of shares in treasury, over 221 million. This means they've been actively repurchasing their own stock, which can be a way to return value to shareholders. But it also suggests they might not have better investment opportunities for that cash right now. Now, looking at these results more broadly, General Mills is in a period of significant transition. The divestiture of their US yogurt business is a huge strategic move, and it's naturally making their year-over-year comparisons look a bit messy. The North America pet segment is undoubtedly a bright spot showing strong growth. However, the struggles in their largest segment, North America retail, are a concern. They are facing volume declines, and the increased costs of making their products aren't fully being offset by price increases. This forces them to rely on cost cutting and divestitures to prop up their overall profits. The significant restructuring and impairment charges highlight that they are making tough decisions to streamline their operations, but these come at a material cost in the short term. It's a company actively trying to reshape itself for the future, but the path forward involves navigating challenging market conditions and absorbing the costs of these transformations. Alright, that is our breakdown of General Mills' latest filing. What is your take on these numbers, their strategic shifts, and what they signal for the company's future? Are they doing enough to offset these headwinds? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps us out, and make sure you subscribe for more deep dives into the financial world. And hey, we have a fantastic community over on Discord, so check out the link in the description if you want to connect with other finance enthusiasts. Thanks for watching, see you next time.